Great. Welcome. Okay, we're going to get started. Good afternoon. Thank you for joining us. My name is Elisa Douglas, Director of Alumni Engagement and Programs at Columbia Business School. Welcome to our CBS Faculty Live virtual talk. This virtual series brings our CBS thought leaders to you no matter where you're located. In just a moment, we will hear from Professor Brett House on understanding the global economic context. This session will equip business leaders to understand emerging developments and long-term trends in the global economy and interpret what they mean for their organizations. So over the next hour, Professor House will present and then open it up for Q&A. During that time, we ask that you please use the Q&A function to submit your questions. Now, without further ado, I'm going to hand it over to Professor Brett House.
Well, thank you very much for having me, and thanks to all of the alumni around the world and here in New York who are joining us today. I am a professor of practice in the economics division here at CBS, which means I came here 3.5 years ago from a career about one-third in international public policy, a third in academia, and a third in financial markets here in London and in Toronto, where I'm originally from. Today, we are going to be taking a bit of a flashback to some of the issues and ideas that you would have covered in global economic environment, our core macroeconomic course here at CBS, and recalling some of the key frameworks that we cover in that course in order to enable us to have a model and a structure for thinking about where the economy is now and where it is likely to go in the remainder of this year in light of the war in the Persian Gulf and domestic policy developments. Our plan for today is to look at why macroeconomics matters so much for business, how we break macro down into two comprehensible pieces, the supply side and the demand side, what drives the ups and downs or the recessions and recoveries that we see with some regularity in the economy, and how we use fiscal and monetary policy to try to dampen them. Lastly, we'll do a bit of a scorecard on the White House economic agenda and look at where economic developments around that agenda are likely to go in the near future. In the course of my talk, I'd encourage you to lodge questions in the Q&A. I will wrap them together, aggregate questions that are similar to one another. In some case, questions that are incredibly specific, I may broaden out to ensure that they're as applicable as possible to as many listeners as we have on today. And then at the end, I'll throw things back to our colleagues from Alumni Relations to wrap up and anticipate their next event in this series. So please do weigh in with your questions in the Q&A, and I will attempt to get to as many of those as possible. And I certainly encourage you to follow up with me after the talk today if you have specific points that we are not able to go into the depth that you would like in the course of our hour together. I am contactable through the CBS website, through LinkedIn, and through alumni relations as well. So why does macroeconomics matter so much? Most businesses are really in the micro side of economics, thinking about pricing, about strategy, about competitive market issues. But as I advocate in our courses here, if culture can eat strategy for breakfast, then macro can certainly eat micro for lunch. It is impossible to be agnostic, as David Einhorn notes about the macro picture, because it has so much impact on almost everything we do as business people. You can have a wonderful plan, you can have a great product, you can be looking for financing with a wonderful cap table, but if the macro environment in which you're launching any of those activities isn't propitious for you, it doesn't matter how great your ideas are, you are going to have trouble getting traction. And in the current international economic environment, I really want to encourage you to slim things down and focus on developments in two large economies in the world, essentially the US and China. Those of us who are from other economies are from the supporting actors in the global economic context. We really have to take pricing, market structure, and developments around capital and trade flows largely as a given by what is happening and what is done by the US and China. We are the supporting actors to these two lead actors. And if we want to simplify and understand what the biggest factors are driving global economic developments and the current context we're in, we need to understand what's happening with the US and China. Most of my talk today is going to focus on the US because the biggest driver of volatility right now and change in the global economic context is Washington, D.C., and the policy decisions and announcements coming out of the White House. The key driver, as you might recall from global economic environment, that has meant that China and the US are the two biggest economies, the two drivers of what we see in the global economy are their commitment to research and development. As you might recall, when we look at long run growth in any economy, it is total factor productivity, innovation, and the innovations that allow us to use capital and labor more effectively together that sustain and drive long run economic growth. And if you look at spending on research and development, which is a decent proxy for the innovation that follows, you can see that the US and China dwarf almost any other economy in the world, even those that are some of the leading sources of startups and innovation. And that commitment to research and development has been what has led to both of their successes over the last few decades. And in the case of the United States, is deeply imperiled by changes in federal policy toward immigration and toward the funding of STEM related areas. Now, when we started 2025, looking back a little over a year ago, a major survey from the Wall Street Journal, which is done semi-annually and looks at leading forecasters' views on where the US economy is going, those forecasters put the probability of recession in 2025 at a 3-year low. So any contention from the White House that it was handed a terrible economy, a mess, a debacle that needed to be cleaned up is demonstrably false. We came into the beginning of 2025 with a much higher than expected rate of growth in 2024. And 2025, while it was set to cool, was looking like another positive year as we entered into it. In fact, what we got was the slowest growth in a decade outside of the pandemic in 2020. And it truly gives substance to the notion that you may have seen in a variety of memes that if the Trump administration had simply gone golfing for most of the last year, we would have had a better set of economic outcomes than we've seen as the result of its policy initiatives. The so-called Liberation Day tariffs announced in April of last year and the uncertain implementation of them, as well as a host of other volatile and erratic policy moves, have contributed to a chilling on investment, a chilling on hiring, and a marked slowdown in economic growth compared to what we likely would have otherwise seen. It could have been worse. We could have seen much lower growth if the tariffs actually announced in April of last year had been implemented. And you will see some skeptics say economists, such as myself, got the outlook for 2025 wrong. That, we expected much slower growth even than the 2.2% that we recorded. That was wholly based on the fact that we took the White House at face value in April of last year, and we thought it may actually implement the crazy and truly unhinged and unsupported tariff rates that it proposed at the time. The fact that growth came in a bit better than some of the most dire predictions is not a vindication of White House trade policy, but rather an indication of how much they retreated from the truly dire policy levels of tariffs that they had contemplated at the time. We have not seen the winning that the State of the Union address claimed the US economy has experienced over the last year. In fact, since April of 2025, we've lost jobs on a net basis, and some of the biggest job losses have been in the tech sector, the big area that we expect to continue to drive innovation and total factor productivity growth going forward. So I mentioned all of this to level set on where we came into 2025 and what we've seen since then, and to then, set up the context in which we're going to look back at some of the things you would have learned in global economic environment in the core here in the MBA to anticipate where we're going next and to simplify what is a very complicated global economic environment into a few key things to watch. And here, I'll start off by breaking the macroeconomy down into supply and demand. Now, you'll recall from microeconomics that we can, look at a world for a single good or service in terms of people's willingness to pay, the demand for that good or service, which is generally increasing in decreases in price. Lower the price, generally people want to buy more of a good or service, and the higher the price, the more likely they are to supply more of that good or service. We can aggregate a little heroically up from all of these single goods and services markets to a picture of the macroeconomy that looks at aggregate supply and demand, not just the price and the quantity of a single good or service provided. So here, rather than looking at the price for a single good on a vertical axis, we have an index of all goods and services prices. And along our horizontal axis, GDP here, rather than the quantity of a single good, the value of all goods and services produced is going to be our other major variable. Aggregating across all markets, we can draw an aggregate demand curve and an aggregate supply curve and determine a general price level and the total value of output in an economy that is consistent with the supply of goods and services being met by demand for those goods and services. Now, recall, this is all a little bit more complicated than if we are looking at a single market. And that's largely because all of us are on both the supply side and the demand side of the macroeconomy, the aggregate picture that we're looking at here. You are both a supplier of labor services in whatever job you do. You may also help run a company that is supplying goods and services. And as a consumer and as part of a supply chain, you also demand goods and services. So all of us exist on both sides of this equation, and that complicates our analysis, but we're going to abstract a bit from those complications as we move forward. Now, recall again, every quarter and every month in many economies, we tally up gross domestic product, which we can look at from three different perspectives. The total value of inputs into the production of goods and services in the economy, which I've laid out in a simple form here, which combines capital K, labor, and multiplies them by the effectiveness or the productivity by which we use them. Now, on the input side, we know that capital accounts for about 30% of the value of inputs, and it's still the case in most major economies that labor accounts for about 70% of the value of inputs. First off, that's why we focus so much on labor market data month on month. We're about to get the next non-farm payroll data print for the month of March, in the first few days of April. And we look to that as a major barometer of how the economy is doing, largely because it accounts for such a big share of inputs, of the value of incomes paid to either capital labor in the production process. So the first place to look for the health of the economy is those monthly prints on the health of the labor market. Hiring, firing, quits, and the number of new payroll versus non-payroll jobs that are being created. The second way to look at the supply side of the economy is the value of outputs. How much is leaving the either actual or metaphorical factory gate? The value of goods and services going out the door from their production center. Here at CBS, we're producing education services every day. And if you go away from this conversation with any better sense of how the economy works than we have added to the supply side measure of output in the economy in the course of this hour. Now, when we look at a typical economy like the US, we normally see that services account for far and away the largest part of the economy. Recently, the United States has been between about 75 to 80% of production. Industrial production, despite receiving a huge amount of attention in the headlines and in trade policy discussions, accounts for a much smaller share, usually less than a fifth, and natural resources and agriculture often in the single digits. Again, this is why when we look at how the economy is doing, we tend to look first at those labor market data because the most labor intensive, the most concentrated use of labor in any economy is in the services sector. So, tracking how labor is doing, tracking how the services sector is doing, is going to give you a very good picture under a kind of 80-20 rule, almost literally here, of how the economy is evolving. So, you don't have to look at every data point on the economy. You certainly don't need to disaggregate deeply into all of them to get an initial sense or to track out of the corner of your eye, because all of you are doing things other than being economic forecasters. But what you want to be able to do is to update your view on the economy with just a few key data points that come out on a regular basis. And you don't need to know exactly what those numbers are. You just need to know, are they tracking better or worse than was previously the case? And following what's happening in the services sector, following what's happening in the labor market, particularly because labor markets are the biggest determinant of the consumer spending we're going to see on the demand side. So we've looked at two measures of the supply side of GDP, and long run growth is determined by that supply side, how well we use capital and labor to produce output. We can't demand our way to higher growth and development over time. We have to supply it. But we also look at the demand side of the economy, the amount of spending that is happening on a monthly basis and then aggregated up to the quarterly and annual basis as another picture on what gross domestic product looks like. And this is maybe the one that's most familiar to us in terms of high frequency data, the combination of consumption, private investment, government spending, and trade that add up to aggregate demand. Now, again, with a focus on distilling everything down to a simple picture of the macro economy here in the US, in your own country, or globally, it's worth noting, that the biggest driver of aggregate demand is private consumption at around two-thirds to 70% of expenditure in most economies. This is why, again, we track something like retail spending so closely as a harbinger of where economic development is going. It is also why labor is such a critical issue because the biggest determinant of consumer spending is whether people have jobs. And if you're trying to anticipate where spending is going next, if you're a consumer focused business, looking at those monthly job prints is going to be the clearest way to anticipate where the broad context for your business is going to be determined in the coming months and quarters. So those demand side considerations are what drive the ups and downs in the economy. Our long run trends are determined by the amount of capital and labor and the productivity by which we use them, and by the amount of output that we're able to produce with them. The ups and downs, the recoveries and recessions, are determined entirely by consumption, government, investment, and trade, those demand side expenditure numbers that can move a great deal more quickly. Put it in sort of practical terms, it takes a long time to build a new building like the one I'm standing here in Kravis Hall. It takes a relatively short time for you to wake up one day and think, my job prospects are a little worse than they were previously. Maybe I'll hold back on that Birkin bag, or maybe I'll simply hold back on that small treat of a $6 latte. Either way, those consumer decisions can shift much more quickly and drive demand above or below our installed capacity to produce on the supply side. And it's those decisions that drive our ups and downs in the economy. Now, when we put this all together, you can see that those aggregate supply and aggregate demand measures are intimately related to our measures of GDP. Aggregate demand is simply summarized by those four sources of expenditures. Aggregate supply, we can add up either by looking at the total value of inputs or outputs. Either way, they have to come together in an economy at a common level of GDP with a related price level. And it's shifts in aggregate demand that are going to determine whether we are experiencing higher growth and often inflation that goes along with it, or lower output and reduced inflationary pressures. And it's going to be the job of fiscal and monetary policy together to try to ensure that demand gets lined up with the amount of installed capacity to supply goods and services that we have in our economies. So that sets us up to think about recessions, recoveries, and milder forms of accelerations and slowdowns in our economies, which is relevant right now because we are seeing a market threat to growth in the combination of economic policies being launched by the White House and Treasury at the moment. Now, recessions are regular events in the US economy. You can see from this chart where gray bars indicate periods of contraction or negative growth, which we've called out here with the accompanying years. You can see they're a feature at least once a decade over the last 60 years or so. They've become more spread out, as I would argue we've become better at using policy and institutions to regulate ups and downs in the economy, which is useful for long run growth and development. All of us find it easier to make investment and pricing decisions, either in our personal lives or in our professional lives, if we have some sense the economy is moving in a relatively smooth fashion without big dislocations in demand for particular goods and services and the prices and interest rates that go along with them. You'll note, though, the last two recessions here were extremely deep. So while we've got better at preventing or at least stretching out the periods between ups and downs, the last two big downs were deeper than any we had seen since the early 1980s. So putting all of this together in one big picture, I like to note, where we have GDP or total output on our vertical axis and time or the amount of wealth on our horizontal axis, our amount of activity, either measured from the supply side or demand side in any one period, is our GDP. That green line shows how it develops over time as we combine capital and labor to produce aggregate supply or total output of goods and services. We know that we require all three of capital, labor, and productivity to drive growth over time. But oscillating around that installed capacity is aggregate demand, which peaks and troughs depending on how both people and businesses, are feeling about their pricing prospects and demand for whatever they're selling. Now, when aggregate demand is higher than our installed capacity, we get overheating. We get inflation like we saw a few years ago in 2022, getting up to 8 or 9%. And we see people pulled off the sidelines and into the job market. In contrast, when aggregate demand is too low, we are going to get lower price pressures and lower growth. Now, the job of fiscal and monetary policy is to dampen those ups and downs. But let's first take a look at what allows those ups and downs to happen. It's mainly the labor market. When demand is high, we can raise wages and pull more people into employment. And when demand is low, we tend to find it relatively easy to lay people off, reduce the number of shifts in a factory, reduce the number of working hours, have fewer people, staffing any kind of activity. When demand is too low, that is going to result from any one of our four expenditure factors. And as you can see, it's going to shift the combination of prices and absolute levels of output to the left and result in lower price pressures and lower output. The job of policy then is to shift aggregate demand back to the right and move us from B back up to A. In contrast, when we've got overheating, when any of consumption, investment, government, or trade is a little too strong, and right now it is largely government that is a little too strong for the installed capacity we have, we are going to see aggregate demand shift to the right and push up prices above what they would otherwise be and move us from A to B. Here, the job of fiscal and monetary policy is going to be to bring aggregate demand back down. And so that's what we'll look at now. When we look at the dilemmas faced, particularly by the Fed, in navigating through the combination of policy decisions and private sector economic developments they're facing right now. So I mentioned the job of monetary and fiscal policy is to dampen those ups and downs. Let's remind ourselves exactly how those two policy levers do that. It is the job of both policy levers to shift consumption, investment, government, or trade in whatever direction we need in order to align demand with the installed capacity that we have in our economy. And fiscal policy is the domain of taxes and spending. Monetary policy, setting interest rates, effectively the price of capital or credit to either make it more expensive when we need to reduce aggregate demand or less expensive when we need to boost it. Now, I argued earlier that we've seen a improvement in our ability to try to regulate the economy. We've seen longer periods post World War II of expansion as you see those blue bars get wider and fewer areas of blue underneath that midline horizontal axis, which are periods of recession. They've been shorter and less frequent, but the last two have been deeper. So we certainly haven't mastered our capacity to stabilize the economy, but I would argue since World War II, we've certainly gotten better at it. When you see how much longer the periods of expansion are here in our chart. Now, with fiscal policy, with taxes and spending, when we want to boost aggregate demand, we're simply operating through G on our expenditure side to raise aggregate demand out to the right. When we want to bring it down, it's again operating through taxes and spending on G to shift aggregate demand to the left. Fiscal policy ends up being relatively straightforward. What is also straightforward is that this is not an administration committed to reducing US deficits or dampening aggregate demand to control inflation in any sense when one looks at its spending and tax proposals, which were recently institutionalized in the so-called One Big Beautiful Bill Act, which some have mentioned is, includes a triple B because that's where the US credit rating could be heading. On the forecasts of the Congressional Budget Office, the nonpartisan inside think tank based at the US Congress, they see deficits as a share of GDP going up toward 8% over the next decade. We are already at very high deficit levels as a share of GDP. These numbers would truly be unprecedented outside of a crisis or a war. That is going to push our debt to GDP levels in the US. Again, this is a Congressional Budget Office chart here. That is set to push debt to GDP levels higher, substantially higher than we saw at the end of World War II, the previous high watermark for government borrowing. That is going to lead to two big things, I will argue in some of our subsequent slides. A big and sustained increase in the trade deficit and a permanently higher setting for interest rates as the US government competes with the private sector for capital. Now, shifting to monetary policy, which is really the area that's received the most attention in the last year or so in the fight, in the aggressive browbeating by the White House of Jerome Powell and the rest of the Fed. Central banks have a lot of jobs. I'm going to focus here only on their role in controlling the cost of capital. And you might recall again from our macro core that they operate under an inflation targeting regime where they are trying to affect the real interest rate or the real cost of capital that you face, which is whatever nominal interest rate that is relevant for you at whatever tenor or maturity is important for you, less your pricing power expectations or inflation expectations about the future. And it alters the nominal interest rate through its regular 8 times a year setting or decision on the federal funds rate by the FOMC. The Fed can also drive nominal interest rates through quantitative easing and tightening, and to a much lesser degree than they did in the past, shifting the share of deposits that have to be held by banks as reserves to meet your cash demands either upward, where they want to dampen or raise interest rates, or downward, where they want to make credit easier to access. What is new under inflation targeting regimes since the early 90s is that they also use communication to try to shape those inflation expectations. What we saw over much of 2025 was an attempt by Jerome Powell to push those inflation expectations down and push your perceived real interest rate up because he didn't have the political wherewithal to raise the nominal interest rate in order to control inflation. So he had to act through the testimony to Congress, the pressers, the FOMC statements, and other speeches to try to move inflation expectations when it would have been politically contentious to push up nominal interest rates in the midst of an ongoing spat with the White House. Now, these movements in real interest rates are occasionally pushed into negative territory. As you can see here, has been the case through much of the 2000s. That is certainly by design because most central banks are wary of putting nominal interest rates into negative territory. And instead, they can use inflation expectations to push real interest rates into negative territory and make monetary policy incredibly stimulative in the wake of recessions where they have tried to push aggregate demand upward again. Now, looking back at our aggregate demand framework, anything that central banks do to make borrowing cheaper or holding cash costlier are going to operate indirectly through a stimulus to consumption and investment. And similarly, if they push interest rates up, they're going to dampen consumption and investment by making it more expensive to borrow or more attractive to hold cash. In contrast with fiscal policy, monetary policy operates indirectly. We don't know that just by making money cheaper, we're going to boost consumption and investment. We take it as a given, but we know during the financial crisis in 2008 and again during COVID, making money incredibly cheap wasn't enough to stimulate demand. And we rely as central banks on the notion that open market operations, movements on very short end maturities of the curve in fixed income markets or notes markets, is going to be enough to transmit to the longer end of the curve. The hope is by changing the cost of borrowing overnight or over 1 week or even up to a month, that there will be a transmission to the entirety of the fixed income yield curve and either move it up or down consistent with those short end movements. Now, what we saw during past episodes of rate decreases, the Fed funds rate here is in blue, we typically see the 1 year, the 5 year, and the rest of the term structure follow, sometimes with a lag, as you can see in the wake of the 2008 crisis and in the wake of the 2020 COVID crisis. And in fact, we know that private borrowers don't borrow at the benchmark government yield. They borrow at some spread to that benchmark yield. And so the hope is by bringing down that benchmark curve, we also, change the borrowing costs for private borrowers as well. In the wake of those last two big recessions, we didn't see longer run yields come down to the zero level that we put the Fed funds rate at. In fact, what we saw is that monetary policy transmission break down. That movement in short-term rates didn't flow through entirely to longer-term treasury rates, mortgage rates, and borrowing costs for firms and for households. And that breakdown meant that the central bank had to step in and do so-called quantitative easing, buying all of those longer-term types of paper in order to push their yields down consistent with what short-term monetary policy was doing. So that short end move by central banks, it's hoped will translate into longer run yields moving consistent with the short run. But where it doesn't, the central bank can step in and buy that longer term debt and push yields down, as it did in 2008, 11, and 13 to boost the Fed's balance sheet. Now we're seeing a reversal as some of that debt is being allowed to roll off as it matures, but is not having a meaningful impact on inflation or rates yet at this stage. Now, setting all this into context of those last two big downturns, the COVID recession was really remarkable because we saw such a quick rebound, because we learned lessons from past downturns. We threw a huge amount of effort at pushing up the aggregate demand in response to the pandemic through government spending and through very cheap money. That learned lessons from the 2008 crisis, where that downturn you see in the blue line here in real per capita GDP was never fully recovered. We never got back on to the pre-global financial crisis trend because arguably Congress and the White House couldn't agree on enough fiscal stimulus. And we arguably, even with a huge introduction of quantitative easing, still didn't do enough to get rates low enough to stimulate aggregate demand when folks were worried that the entire US financial sector was insolvent. So that V-shaped rebound in 2020 is really a product of the lessons learned from the global financial crisis. So where does that leave us now on the White House economic agenda? This will be a very quick trip employing all the tools that we've just revived in our minds from GE. And the key thing to keep in mind is that the traditional role of monetary and fiscal policy, which is to dampen volatility, to reduce those upturns and downturns, that's been turned on its head. In fact, the index of global economic policy uncertainty has been boosted by policy announcements, typically those coming from the White House, rather than decreased by policymakers. And that has real implications for the five big things this White House has laid out on its economic agenda: smaller trade deficits, slower inflation, lower interest rates. They've been a little equivocal on what they want for the dollar, but they've certainly been clear they want higher growth. So, taking us back to the GDP expenditure function here and doing a little bit of algebra, we're just moving consumption and government to the left-hand side. That difference between total income less what the government and private sector spends is what we can call as savings, which is a flow in any one year. Investment on the right-hand side is just the amount of output that we set aside to add to our capital stock. Both of these, again, I want to emphasize, are flows, not stocks. What all this allows us to do is write this key identity that savings minus investment determines our trade balance. And what I want you to observe is that the US, which has savings less than investment demand, is running a trade deficit because of that domestic imbalance. And tariffs can't alter that. Tariffs can't close a trade balance or a trade deficit when there is a deficit of saving versus investment demand in an economy. China is the flip side to this. Thinking about our two big economies, China's trade surplus is derived from the fact that it continues to save more than it's able to invest domestically, and it sends that excess savings to the United States to finance its trade deficit. The key takeaway is you can't close a trade deficit unless you close that domestic imbalance. And that domestic imbalance has been reflected in the current accounts of major Asian economies in the United States for years. The United States has been in a substantial trade deficit, reflecting that savings and investment imbalance for over 30 years at this point. And if we look at the Trump 1 administration and the huge expansion in fiscal deficits, which was warranted in response to the pandemic, you can see if you look at what is driving that savings and investment imbalance, it is almost wholly government here. It is almost wholly a continued and persistent fiscal deficit that is set to get even bigger, not smaller. So as a result, we're not going to see trade deficits get smaller, no matter how many tariffs are put on. In the presence of fiscal deficits from Washington, they're set to get bigger. We know that we have a natural experiment in this. The first Trump administration had a marginal impact on shrinking the US trade deficit with China. But as it ballooned, the fiscal deficit, we saw the overall trade deficit with the entire world get bigger, as is shown in dark blue here, get bigger with the rest of the world outside China, not get smaller. And we'd expect that to happen again, and it is happening again. The trade deficit with China is getting smaller, but almost every other major emerging market is seeing a boost in imports to the United States. Vietnam and Taiwan are noted here. If we look at how the trading patterns of the United States with the rest of the world have shifted, there has been a big shift away from China, Canada, the EU, and Japan. But almost all of that has been shifted to other emerging markets that have relatively lower tariffs on them. And it has meant that rather than getting the trade deficit down, it actually got bigger in terms of goods in 2025, not smaller, despite all of those tariffs being put into place. So we're getting much as economists would anticipate exactly the opposite of what the White House says it's trying to achieve. So we're not getting smaller trade deficits. You will note, though, we actually did get a slightly smaller overall trade deficit in 2025 because services saved the numbers ever so marginally. But on the things that mattered to tariffs, we got a bigger deficit, not a smaller one. Now, on prices, we have been broadly in consensus across the economics profession that tariffs are going to be inflationary. I'm taking you back to the market for a single good or service. We start off at equilibrium. We impose a tariff that reduces the supply of that good coming into our local market in the US, pushes up the price for US businesses and consumers. And you might see a little bit of price shaving by producers in the rest of the world. But by far, the most of the burden of these tariffs is falling on US businesses and consumers. If we look at data compiled by the US Census Bureau and the New York Fed, that blue here shows you how much of the share of tariffs is being passed on to US consumers and businesses. It's north of 85 to 90%, and that has gotten bigger over time, not smaller. And so tariffs have added substantially to inflationary pressure, not just because they've affected import prices, but they've also provided cover for domestic producers in blue here to lift their prices way above what the trend had been coming into the so-called Liberation Day. So if we think about this in a macro sense, we are seeing a big decrease in the supply of goods into supply chains here. That's pushing up prices from our equilibrium at A to B. Add in immigration policies, also shifting aggregate supply back to the left. You've got a recipe for higher prices and higher inflation. So, in that context, how do you lower interest rates? Well, in fact, all the browbeating from the White House has made it harder to get rates down rather than easier. When we came into 2025 and we already started seeing the beginning of the browbeating of Jerome Powell, all of that had the impact of raising inflation expectations. If we thought the Fed would not be able to follow through on its mandate because of the pressure from the White House, that raises inflation expectations. That lowers the real interest rate, makes it cheaper to borrow and stokes aggregate demand. And that perversely then makes it harder to get the nominal interest rate, the Fed funds rate down. And that's why when we proceeded through last year, Jerome Powell kept saying he's not in a hurry to cut rates. He wanted to make it clear he was going to push inflation expectations down to try to control the real interest rate and get inflation, which has been persistently above target, back down to 2%. Now, in January, we saw the first pause since July 2025, where we didn't see another cut after the cuts that we saw in the fall of 2025. And essentially, that's a debate between what I call the levelists and the marginalists here. The folks who looked at growth, unemployment, inflation all said, inflation not so bad coming down, but unemployment is going up, growth is slowing. We better cut the nominal interest rate. The other camp, which is made up of the folks who look at the models the Fed and other macroeconomic shots run, said, against R star, our natural rate of real interest that is neither stimulative or contractionary, it's not clear we need a cut. And so let's look at the numbers. Whenever R is higher than R star, we've got constrictive monetary policy. When it's lower, it's stimulative. And R star has been coming down over the years because we've got slower productivity growth, aging populations, economies that can't essentially sustain the higher rates that they used to be able to grow within in the past. So, looking at where our Fed funds rate is, the Fed funds rate minus 2-year inflation expectations adds up to a real interest rate of only 0.57% against a natural rate of interest that's 1. That's saying we don't need any more cuts at this point. And so that's in part why you've seen them priced out by Fed funds rates futures. And what's more, even though you've seen short run rates come down compared with a year ago, you've seen longer run rates pushed up as markets get concerned about those fiscal deficits and the inflationary impact of this war. So far, our report card's looking pretty terrible to bring home to the folks. What about the dollar? Well, here I'm reminded of the Nobel Prize winning work of a Canadian Columbia economist, Robert Mundell, who noted that you can choose as an economy only two corners of this triangle in what he called a policy trilemma. Most economies, like the US and Japan, choose to have free capital mobility in and out of their markets, and they choose to set interest rates to raise or lower aggregate demand as local conditions require, which means they can't control their exchange rate. They have to let their currency float. Contrast is China, which has chosen to fix the renminbi to keep it relatively cheap against the US dollar and stimulate exports. That means it's chosen exchange rate management. The PBOC, the central bank, sets interest rates for local market conditions. But as a result, it can't also allow capital to flow in and out of the country because it may undermine that exchange rate peg. Third set of countries are countries like Argentina and Hong Kong that have attempted to fix their currency against the rest of the world, against the US dollar in both cases, while still maintaining capital inflows and outflows, which means they can't set interest rates for local conditions. They just have to adjust interest rates to whatever is happening in the United States. All that's relevant here because the US, through most of 2025, was looking at Fed cuts in the midst of higher inflation, a classic situation which sets the value of the dollar here against G10 and EM currencies for depreciation. We've seen a bit of a reversal as a flight to safety into the US dollar has pushed up its value. I see that being only temporary because we've seen interest rates increase in the rest of the world far more than the two cuts we've seen priced out of the United States. Expect the US dollar to start softening again. So if we're looking for a stronger dollar, that is going to be something that will not be a durable feature of the current outlook. And then lastly, in Q1, we saw the Atlanta Fed in a way that's not quite unprecedented, but is certainly exceptional, slash its growth forecast by a whole percentage point in response to the combination of trade war and actual war. And it is not clear US productivity growth related to AI is going to save us, despite a lot of hype. It still remains rather middling, not exceptional in any way. And so, looking at our scorecard, we've got five objectives and five objectives that are unlikely to be obtained in the course of this year. So, just summing up, what are the big insights I'm going to try to leave you with? It's that macro matters for all of your businesses. You can take the big, hairy picture that is a complicated macroeconomy, break it down into the supply and demand sides, understand how both of them are evolving on the basis of just a few data points, particularly around labor, services, retail, and then anticipate how monetary and fiscal policy will adjust to bring demand and supply in line with one another, and observe that with huge fiscal deficits and the browbeating of the Fed, we're unlikely to achieve slower inflation, smaller trade deficits, or lower interest rates, or a durably stronger US dollar or US economy. So, in contrast to winning, I'm seeing a lot of losing ahead. And if you'd like to follow up on this in any way, you're welcome to keep in touch via LinkedIn or our contact details on the CBS website, and come back and see us here at Kravis Hall. I'm just going to look to a few of the questions that have come in order to respond to some of your queries. Um, okay, a few questions here. How do you see the share of labor evolving over time in the input side of the economy? Well, Thomas Piketty in his tombstone of a book, Capital, highlighted that at the margin, labor has been seeing its share of total income eroding over time. And that's certainly continued to be the case over the last 20 to 30 years. It is still the lion's share of income, but at the margin has been shifting downward, particularly as globalization, technological change, and the strength of unions has declined. So, we do see a continued pattern on that front, which Greg Ip nicely highlighted in an article recently in the Wall Street Journal. Now, there was a question about the US unemployment rate at 4.4%. Does it include people who stopped looking for work or exhausted their benefits? It does not. If you stop looking for work, you are no longer considered participating in the labor market and an active unemployed person. And so that's why participation rates are so important too. And as we've seen the unemployment rate creep up over the last 2 to 3 years, we've also seen the US participation rate crash. We are back to levels from 4 years ago, where a lot of the recovery post pandemic has been unwound. So we are seeing more people sitting on the sidelines again. Now, what's the impact of AI? As I mentioned, so far we're not seeing a big boost to productivity, but that mirrors many other big technological waves where it took years of initial investment and acculturation and learning to make good on the technology in terms of productivity. Nobel Prize winner Robert Solow once quipped in the late 80s that you could see the impact of computers everywhere but in the productivity statistics. But by the late 90s, early 2000s, you could certainly see their impact. So I would say watch this space. Um, on imports and exports impacting the economy. Uh, how big is that as a share of GDP? Well, you see a lot of obituaries being written for globalization. What I would say is that we don't see it in the data yet. Exports and imports as a share of US GDP and global GDP remain at the highest levels that they've been ever. But where imports and exports are coming from and going to has shifted as a result of those tariffs, rejigging the patterns of trade globally. Um, Tariffs aren't reducing the trade deficit, someone observed. That's exactly right, because the fiscal deficit remains so enormous that savings and investment to imbalance locally or domestically will mean that tariffs can't close the trade deficit at any point in the next few years. Now, how do we get out of this gloomy forecast? I would say recommit to relatively predictable, consistent, and rules-driven policy making. Recommit to an international order that is focused on stable institutions and open flows of capital and trade, and ensure that US STEM research and development and green technology is positioned for further gains. With that, I'm going to turn things back to alumni relations and say thank you for joining us today.
Amazing. Thank you so much, Professor House. That was extremely informative. Thank you to our attendees for taking the time to be with us. Our next CBS faculty